Rob Carnell. He's Chief International Economist at ING Bank. He's with me now. And you disagree with those sentiments we're hearing there from Ken Rogoff?
Yeah, what on earth would you do QE3 now for? I mean, Ben Bernanke has been very clear about why you use quantitative easing. It's an anti-deflation policy. He spelled that out over the last two press briefings of the FOMC. Now, do we have deflation right now? We haven't. We've got core inflation rising. It's been rising very, very steadily. It's up from a low of about 0.6 to about 1.5% now. You've got headline inflation about 3.6%. The last payroll survey showed wages growth beginning to tick up. You've got the very opposite of deflation. You've got creeping inflation. So why would you do QE right now?
Well, I suppose some analysts and we're hearing there the views of Ken Rogoff, but we've had a raft of weak economic data over the past few months, and now we're in a situation where global markets seem to be in free fall. I mean, they're hitting new lows that we haven't seen since the financial crisis.
Yeah.
What is the danger of the US going back into recession if we don't see QE?
All we've really seen, yes, we've had the soft patch, and a lot of the data has been very backward-looking on that, so the Q2 GDP data from the US weren't very good, obviously, but it is basically picking up all the soft patch data. There's still good reasons to think the economy will strengthen over the second part of this year. Oil prices are much lower, retail gasoline prices should be lower. Bond yields are very, very much lower, and that should be supportive as well. Good reasons to think it's not going to be great, but it'll start moving forward. If we're always putting policy in response to things that happened a quarter, 2 quarters ago, you run the risk of exacerbating problems.
But how difficult and divisive is the FOMC in Washington going to be today, given what we've seen on the markets, and of course the US debt downgrade, not forgetting that too?
I think you get a sense from various different people within the FOMC that there are very different views across the board. But I think most people view the likelihood of QE3, that the need for that very high hurdles they're talking about needed to be met before you start implementing another round of quantitative easing. And I think those hurdles, basically, we would need to see such weak growth that it did start to impact on inflation. Not just the equity market having kittens about, what the downgrade from S&P means, which, frankly, when you look at it, is negligible. It has had very little effect on anything real. It's just caused the equity market to get very anxious. That might change in a couple of days.
But isn't part of the reason the equity market is getting anxious is that it is being driven by these macroeconomic concerns about global growth slowing and, more importantly, growth in the world's largest economy? Global
growth has slowed. The latest data we've had out of the US hasn't been all that bad. We'll probably get fairly good retail sales data later in the week. The equity market, as it often does, is looking back at all of the bad stuff and going, oh no, isn't it dreadful? We need some support. Ben Bernanke, please deliver. And I think it'd be perfectly justified in saying, no, look, actually nothing's really changed. You've overdone it as usual. The bond market is not reacting in the same way as the equity market. Why should we be there as an equity market support institution? That's not our job. Pull yourselves together.
Okay, well, I mean, are there still, you said there are reasons to think that growth would still pick up this year. I'm just wondering, given the raft of weak data that we have had over the past few months, how confident can you be? Can you really say with certainty that the rebounding growth that so many have been speaking about will actually materialize in the second half of the year?
I think cautious optimism is the right way to put this. I don't think, at ING we wouldn't be talking about a massive bounce, a resurgence in 3% plus growth. It's a return to something like trend, which we think is around 2.5. The disruption from the Japan earthquake, tsunami, is coming to an end. We're seeing that in some of the auto data. So that bit of the soft patch is coming to an end, so manufacturing should start to pick up. And though some of the leading indicators remain on the soft side, that's a reason not to get too over the top about this. There's also some inventory rebuilding to take place over the next couple of quarters to offset some of that disruption as well. And as I said earlier, some of the other data coming through on the consumer side don't look as bad, and the labour market isn't as bad as people have been making out.
But how can that be? I mean, unemployment seems to be stubbornly high. It hasn't come off 9%.
Yeah, 9%, but it was 10.1%, so it has actually made quite a lot of improvement. People get very, very uptight about it, or they expect things to happen overnight. This is going to be a very, very long, drawn-out process. It'll take something like 6 to 7 years, we think, before peak employment, the sort of pre-crisis employment levels, are returned to. The last recession, it took about 5 or 6 years.
So what are you saying, 5, 6 years before we see unemployment come down below 9%?
No, we're at 9.1 now. We'll see unemployment coming down below 9% within the next couple of months, but we'll see it staying stubbornly high, higher than people would like, maybe 6.5%, 7.5% levels for a very long period. That's the new normality for the US.
I mean, nevertheless, what are the options ahead for the Fed today?
Very few. I mean, what would you really expect the Fed to be able to do for the unemployment rates? You've got federal funds rate close to zero. You've got bond yields at around 2.4, 2.5% on the 10-year Treasury. That's pretty low. That's very supportive of the mortgage market. What else can they do, really? You've got the dollar, which is not particularly unsupported. It's not down to the Fed anymore. They've done what they need to do. It really is down to the politicians and fiscal policy, only we know there that there's no chance of there being anything particularly substantial. The one possibility, one hope, people are talking a lot, there's a lot of chat about a second type of Homeland Investment Act, bringing home to the US profits that are sort of sequestered overseas and ring-fencing them for investment or job creation in the US. That would actually probably have quite a lot of chance of getting through politically.
But would it have enough of an economic impact in terms of growth and bringing down unemployment?
It would be a lot more useful than another round of quantitative easing, which all that would do would be to drive up the stock market in the short term, drive the dollar down, push up dollar commodity prices around the world, get the Brazilians and the Chinese up in arms and start more cries of currency wars. Frankly, it would do more harm than good.
Perhaps give some relief to equity investors.
Oh, yeah, and they would love it, but, they're not the whole world, are they?
And, I mean, just looking at what's been happening in European markets today, I mean, a very volatile session, no relief. It started in Asia, it could continue on Wall Street. Is it mainly, what is this all about? Is it mainly global macroeconomic concerns?
I think this is still all about the debt crisis in Europe, and in combination, that slightly poor timing by the S&P to downgrade the US at the same time. That just didn't really help. It exacerbated the problems. And it's the usual thing. We're getting a sort of financial market overreaction to the under-response of the institutions in the Eurozone to what's going on.
I was just listening to what you said to Maryam before I came to join you, and you said, look, you're all hoping for QE3, be quiet, that's not what the Fed is there for, get on with yourselves. Have markets become, I think it's it's a fair point, have we all become over-dependent on, where's the central bank, please come save us, whether it's the ECB or the Fed? So if they're not the saviours, what is? Because these markets have definitely got an attitude these past 3 days.
Oh, they have. But I think, the equity market's sort of worrying about, in a sense, the bond market in the Eurozone. It wants the bond market to be saved in a way. And the problem is really what we've got right now is the ECB coming in, it's buying Spain, it's buying Italy, it's doing pretty much what's necessary. The thing that's missing at the moment is that the vehicles, the institutions put in place are still viewed as being insufficiently large to cope with potentially an expansion of bailout needs within the Eurozone, and at the same time acting in secondary markets to buy the distressed debt economies of Europe. It can't do both, is what the market's saying. We need more, and they haven't got it.
But is the reality of what we're looking at in markets that fiscal austerity is coming right down the track here in Europe? Spain, Italy, moving more aggressively in their austerity programs. That is surely going to leave us with a very long period of time of where these European peripheral countries are under pressure.
For sure, and the reality is we shouldn't be thinking years, perhaps a decade plus, in terms of the slow growth environment.
Is that our new norm? Do we have to get used to higher unemployment and lower growth?
Yeah, when we were talking about the US, we were talking about what should we expect in terms of the unemployment rate for the US, something around 6.5, 7 for them. I mean, we're in Europe, we're used to higher long-term unemployment rates anyway, but, we're going to have to sit around with that for a long time anyway. There is a new switch, it appears, to try and focus more on structural growth-enhancing measures, but, we've lived through those in the UK, and they take forever to actually have an impact.
And that is precisely the problem, isn't it? That the reforms that we're talking about here in Europe, but not just in Europe, also to really kickstart growth in the US, I mean, this is going to take time, possibly up to a generation. So, in the meantime, does a little intervention, does a little QE, I mean, it seems to be what the markets want, right? I
mean, what I said about QE earlier, I stand by. I mean, I don't think it's the wrong thing to do. I'm not saying they're not going to do it.
Yeah.
They're not going to do it tonight. They're not going to, I don't think.
But maybe this year.
But possibly, if the equity market stays low and it falls further, and then it can start to have an impact on growth. The thing about the equity market
is this what they call, is this a negative feedback where you get equity markets sliding, plunging, whichever word you want to choose, bond markets declining, it's just one vicious circle feeding into one another. Is that where we are at the moment?
If they stay low, if they fall further, if they seem to accelerate, then there's scope for central banks to say, look, this is potentially going to feed through into much weaker growth. that starts to have a potential deflationary impact, then we can respond to that. But right now, it's only been a couple of days, hasn't it? If we go back 2 weeks, where were we?
A couple of days. Equity markets have lost over 10% of their value in the past 10 trades. 10%. That is wealth erosion. That is confidence erosion.
And likewise, we could bounce back in the same period.
Yeah, pension.
But maybe I'm.
You're not that old, Maryam.
But I mean, I'm just wondering about. We had some data coming into us from China today. Inflation accelerating at the fastest pace in 3 years, and I remember, we were talking about just a few months ago, perhaps a little more than that, about China being the engine for global growth. But are there now mounting concerns, not just about growth in the developed world, but also possibly slowing growth in emerging markets as well? Are things looking a little more unsure?
I think you would have to be sensible about expecting China and the EM world full stop to be a new powerhouse of growth for the entire world. They still are very much an export-driven region of the world, and without the consumers of the last resort, and that's always been Europe and the US, they're not going to be able to move forward at the sorts of rates of growth they have. China, we're still quite optimistic, and we think that the inflation numbers, whilst they've gone up, the rate of increase seems to be coming to a head. We think it will start to come down before too long. So fingers crossed on that, but still, reasons to be concerned.
Still a risk there,
Yeah. I suppose just one last very quick response on this. Commodity prices are crumbling. Surely, is that a positive for inflation? That leaves some room, some scope.
Yeah, it does. Oil prices coming down. It starts to feed through into retail gasoline prices. Crack spreads are very wide at the moment, and the refiners haven't been passing that on. If they start to, that does make things a lot better.
But then analysts say the fundamentals of supply and demand haven't changed, so maybe they'll go up again. Oil prices.
Well, as soon as things start to recover, they will.
Okay, Rob Carnell, good to talk to you.